In today's video, I'm going to explain over 100 stock market terms that every beginner should know. To make it simple, I've divided everything into 9 simple topics. So if you want to finally understand how the stock market works and learn some essential investing terms, this video is definitely for you. Welcome to Martic Finance, where we explain investing concepts in a simple way. But first, a quick disclaimer. This is not financial advice. Let's start with the most important question. What is a stock? A stock represents ownership in a company. If you own a stock, you literally own a piece of that business. There are 2 main types, common stock and preferred stock. Common stock is what most investors buy. You get a claim on the company's profits and the right to vote on big decisions, but dividends aren't guaranteed. Preferred stock is different. You usually don't get voting rights, but you're more likely to receive steady dividends, and you get priority if the company pays out money to shareholders. Instead of owning just one stock, most investors build a portfolio, which is simply a collection of all the investments you hold. Some of those investments might pay a dividend, which is when a company shares part of its profits directly with shareholders. Not every company's stock is available to the public. A public company has listed its shares on the stock market, while a private company keeps its shares owned by founders or private investors. To measure how groups of stocks are doing, we look at something called an index. An index is a collection of stocks designed to represent a piece of the market and is used as a benchmark for performance. For example, the S&P 500 tracks 500 of the biggest U.S. companies, the NASDAQ is known for tech stocks, and the Russell 2000 tracks smaller companies. When investors talk about trying to beat the market, they usually mean earning a return that's higher than one of these major indexes, especially the S&P 500. Since the S&P 500 is often treated as the standard benchmark, if your portfolio does better than it, you've beaten the market. This is really difficult, and only a few investors manage to do it. All these stocks trade on a stock exchange, the marketplace where buying and selling happens. The largest in the U.S. is the New York Stock Exchange. To actually trade, you'll need a brokerage, a platform or service that connects you to the exchange. They may charge a commission, which is just a fee for making the trade. Every stock is identified by a short code called a ticker symbol, like AAPL for Apple or TSLA for Tesla. Trading happens during official market hours, typically 9:30 a.m. to 4 p.m. Eastern Time. The stock price is the current price of one share. At the start of the day, we have the opening price, and at the end, the closing price. But trading doesn't stop there. There's pre-market trading before the open and after-hours trading once the market closes. This is when investors can still buy and sell stocks outside of normal hours, often reacting to news like earnings reports or economic announcements. The catch is that these sessions usually have lower volume and lower liquidity. Volume shows how many shares are being traded. High volume means lots of activity, while low volume means fewer trades. Liquidity tells you how easy it is to buy or sell a stock without moving the price too much. Big popular companies like Apple or Microsoft are very liquid. Let's move to market capitalization, which is the total value of a company's stock on the market. You simply multiply the stock price by the number of shares. Then there's enterprise value, which looks not just at stock but also at debt and cash the company holds, giving a fuller picture of what the business is worth. Revenue is the total income from sales. After expenses are subtracted, what's left is net income. That's the profit. On the balance sheet, you'll also see assets and liabilities. Assets are what the company owns, like cash, equipment, or property. Liabilities are what it owes, like loans or debt. To compare companies, investors use ratios. One of the most common is earnings per share, or EPS. This shows how much profit is made for each share of stock. For example, if a company earns $100 million in profit and has 50 million shares available, the EPS would be $2 per share. From there, we get the price-to-earnings ratio, or PE ratio, which compares the stock price to the earnings per share. showing whether a stock looks expensive or cheap compared to its profits. The PEG ratio goes a step further. It's the PE ratio adjusted for expected growth, helping investors see if a fast-growing company's stock is fairly valued. For income-focused investors, there's dividend yield, which measures how much you earn in dividends compared to the stock price. Another key factor is free cash flow, the cash a company has left after paying its expenses and investments. It's what can be used for dividends,